Good morning, good afternoon, good evening, wherever you are in the world. Good evening to our two speakers who have stayed very late in Tokyo and Beijing, respectively. I'm Nicolas Véron. It's my pleasure to introduce this new session of Financial Statements, a series at the Peterson Institute for International Economics, where we drill down on somewhat arcane but always important financial topics. Richard Koo is the chief economist of the Nomura Research Institute. He studied initially at the University of California at Berkeley, where he got his bachelor's degree in 1976 and master's degree in 79 at Johns Hopkins. And then he was a doctoral fellow of the Federal Reserve Board until 1981. He joined the Federal Reserve Board of New York at that time. And in 84, when Japan was still on the ascendancy as the country that transformed the world, he became an employee of Nomura, a senior economist, and from 1997, the chief economist of the Nomura Research Institute. He's also been a visiting professor at Waseda University from 1998 to 2010. He's currently also a senior advisor at the Center for Strategic and International Studies here in Washington, a columnist for the German newspaper Handelsblatt. But first and foremost, a very influential, not only commentator, but advisor to a number of Japanese prime ministers, and in a unique position of being very influential in Japanese policy without being himself a Japanese national, because I think you're an American national, Richard. Guo Kai is a senior fellow at the China Finance 40 Forum, CF40, one of the main Chinese think tanks and a long-standing partner of the Peterson Institute. Kai got his master's degree at Peking University in 2003, PhD at Harvard in 2008. He then worked for the IMF, first in the Asia Pacific Division department, and then in the Department of Strategy, Policy and Review. And in 2011, he joined the People's Bank of China, where he spent a decade and most recently as deputy director of the Monetary Policy Department and one of the senior economic experts at the Chinese Central Bank. And he left the People's Bank of China in 2021 to join CF40. With that introduction, let me directly give you the floor, Richard, and I will put your slides on the screen. Thank you so much.
Okay, thank you very much for that kind introduction. I was asked to explain what balance sheet recession is at the beginning, because I'm sure many of you, when you go to universities, you haven't heard this term, because it was invented by myself around 1997, when we were trying to find out what was going on in Japan. As you remember, 1990, the Japanese bubble burst. And as you can see in this chart, Japanese bubble was absolutely huge. Japan was led by commercial real estate. The Japanese bubble was led by commercial real estate. And as you can see, this purple line increasing 5 times in 5 years. From 1985 to 1990, it went up by 5 times and came crashing down, fell 87% nationwide, not just a little corner of Tokyo, the entire country. And the amount of wealth the Japanese lost in the process was something like 15,000 trillion yen, which was equivalent to 3 years' worth of Japan's GDP. But when you look at the Japanese GDP, the black and the blue lines, you can see that it grew up very rapidly during the bubble days, but it never fell below the peak of the bubble. And that's the most remarkable part of the Japanese experience. Why, after losing so much wealth, Japanese GDP didn't fall below the peak of the bubble. But during this period, it was a very, very difficult for the Japanese economy, because we enter what we call balance sheet recession. And how does this recession happen? During the bubble days, people tend to leverage themselves up, borrow tons of money. Once the bubble bursts, asset price collapse, liabilities remain, and the balance sheet's underwater. Balance sheet's underwater means these guys are bankrupt. But there are actually 2 kinds of bankruptcies, and that is one with cash flow and one without cash flow. And if you're without cash flow and your balance sheet is underwater, that's the end of the story, period. But if you have a cash flow and then your balance sheet is underwater, which was the case for most Japanese companies back in those days, where their cars and cameras are still selling very well. Japan running huge trade surpluses because they were so competitive, but the balance sheet was underwater. So in that situation, what are you supposed to do? Well, you're supposed to use the cash flow to pay down debt, because that way you can continue to service your debt. You don't have to tell your shareholders it's all piece of paper now. You don't have to tell your workers you have no more jobs tomorrow. And of course, the bankers will be happy because they are not non-performing loans. So for the individual level, that's the right thing to do, correct thing to do. But the problem is when everybody does this all at the same time, what happens to the national economy? The national economy, if someone is saving money or paying down debt, someone else has to be borrowing and spending money. And in the usual economy, it's people like ourselves, Nomura or Morgan, or, Chase Manhattan or whatever, in the middle, taking the money from the savers, giving to someone who can use it. And if there are too many borrowers, interest rates are raised. Too few borrowers, interest rates are lower to make sure that this cycle is maintained. But when you have so many people trying to repair their balance sheets all at the same time, you bring interest rates down to zero, nothing happens because everybody's still repairing balance sheets. And if your balance sheet's underwater, you cannot borrow. Banks are not supposed to lend it to anyone whose balance sheet's underwater. And so then you get into a very difficult situation where all the saved funds cannot leave the banking system or in the financial system. It can circulate within the financial system, but not outside. Then what happens? If I have $1,000 of income and I spend $900 myself, under the usual circumstances, I will save this $100 that goes into the financial sector, given to someone who can use it. And if that person borrows and spends the $100, then economy-wide expenditure, well, $900 that I spend plus $100 that this borrower spent, $1,000 against the original income of the $1,000, and the economy moves forward. Too many borrowers, rates are raised. Too few borrowers, rates are lower to make sure that the cycle is maintained. But once you fall into what I call balance sheet recession, what happens is that I have $1,000 of income. I spend $900 myself and save this $100. The $100 gets stuck in the financial system. It cannot go out because there are no borrowers. Everybody's paying down debt. Then only $900 is spent. The $900 is someone else's income. If that person says, okay, let's save 10%, spends $810, save $90, the $90 gets stuck in the bank financial system again, because repairing balance sheets after a big bubble could take very many years. In the Japanese case, it took nearly 20 years. So if you do nothing about the situation, the economy could go from 1,900, 810, 730 very, very quickly. And as this chart shows, this is what happened to the US economy during the Great Depression, where from 1929 to 1933, US lost 46% of its GDP, nominal GDP. And that's the danger of balance sheet recession. And the way it happens, change to the next slides. Next slide, please. Sorry for this very ugly chart, but this basically shows who borrowed the money and who saved money in Japan. There's a horizontal line going across zero. Above zero are the people saving money. Below zero are the people who are borrowing money. And there are four lines here: the household line, corporate line, rest of the world line, and the government line. These four lines are supposed to add up to zero. So that basically shows who saved the money and who borrowed that money. And if you look at 1990, the time of the bubble, Japanese households are saving a lot of money, but Japanese companies are also borrowing lots of money, almost 12% of GDP. But once the bubble burst, you see this heavy blue line having a very sharp positive slope. That is to say, they're reducing their borrowings very, very quickly. By 1990, it's above zero. Above zero means the entire corporate sector is paying down debt. And by 2000 something, it was above the household sector. So corporate sector became the biggest savers. Households were saving. I mean, economy started slowing down, so they couldn't save as much as they wanted to. So that's where the line came down. But Japan, we ended up with both corporate sectors and household sector, the entire private sector, saving money like crazy at zero interest rates. That's how we got into deflation. But when you look at the corporate, the government line, the green line, Japanese government was running a budget surplus. It was above zero at the peak of the bubble. Then it went deeply into the financial deficit side, that is the government borrowing and spending money. And it's that part that borrowed $100 and spent it, and that's what kept the Japanese GDP from collapsing. And so once you're in this kind of situation, you have to have a government borrowing and spending money, because private sector are all doing the right things. They are not doing the wrong things. Everyone in that situation, if we are in the same situation, we will be doing the same thing, repairing balance sheets as quickly as possible. So this chart shows what happened to Japanese corporate balance sheets. This horizontal line going across, if the blue bars goes further up from the zero line, that means they are increasing financial assets, so saving. If the orange bar goes further down, that means they are increasing their borrowings. And the net line is this line with small circles. And as you can see, during the bubble days, these guys are borrowing lots of money. So household sector was saving, corporate sector was borrowing, economy was doing great. But once the bubble burst, you see orange lines shrinking, and then it goes above zero. Above zero means the entire corporate sector is saving, paying down debt. And that goes on all the way to around 2013 or so. Then finally comes down. It comes down means finally Japanese corporate balance sheets are repaired. But it took that long in Japan. And the reason is that we did not know what was going on, because this whole concept of balance sheet recession did not exist in economics. And so when BOJ brought the rates down to zero, nothing happened. Why nothing happens? Well, for monetary policy to work, you have to have some borrowers out there who are willing to respond to the signals from the central bank. Sorry, can you go back? But if everybody's paying down debt, the central bank action bringing down to zero or even negative rates, as happened in Japan and Europe, will produce no results because no one is changing their behavior. They're all repairing balance sheets. And so once you are in this situation, I'm afraid monetary policy is largely useless. You have to rely on fiscal policy. But because we were all taught in universities that government borrowing is a bad thing, we never wanted government to be borrowing too much. And that's how we ended up with deflation, first in Japan, and after 2008 in Europe and United States, because the bubble burst 2008 really pushed both Europe and United States into a balance sheet recession. Now, Chinese are already aware of balance sheet recession because so many of them are reading about it every day these days. So unlike 2008 in Europe, United States, or 1990 in Japan, where no one knew about balance sheet recession, Chinese are aware of it. And even though China is falling into balance sheet recession, my guess is that because they are already aware of what kind of disease they have contracted and they know how to cure it, that part of balance sheet recession in China, I think, is can be dealt with. Unlike in Japan, when we had no idea what was going on, or also true in Europe after 2008 in the United States. In the US case, within a year or two of Lehman crisis, both Chairman Bernanke at the Fed and Larry Summers at the White House both understood that, this is balance sheet recession. So they came out with this term, remember, fiscal cliff. US cannot afford to fall off the fiscal cliff, and basically kept the government spending from contracting too quickly. But the Europeans didn't do that. And Europe really fell into balance sheet recession, Spanish unemployment reaching 25% and all that. Chinese are already seeing all of that. And I think they are going to put in the correct policies in hopefully sooner than later. They already put in 1 trillion RMB package, but to really overcome this very big balance sheet recession, my guess is that they will have to do a lot more than that, maybe 5 times. Sorry, I can't follow who is moving the charts? The Chinese article that, yes, this one actually appeared in a Chinese newspaper 2002, so it was last year. They're already talking about balance sheet recession that this guy Richard Koo was talking about. So unlike Western world or Japan, they are aware of it, aware of what kind of disease it is. And if they're aware of it, the only thing that they have to do is just to put in the fiscal stimulus. There's some resistance to it because Chinese budget deficit is actually becoming very large. And that's the next chart, sorry. This is the Chinese flow of funds data. And as you can see, the corporate line actually was going to the positive range starting around 2016. And this one bothers me a lot because this is what you expect during a balance sheet recession, but not when China was doing great, the no bubble bursting, but somehow Chinese companies start reducing their borrowings quite substantially. And that weakened the Chinese economy. To stop that, you can see the government line moving in the opposite direction. And this is where all these regional governments have to put in the fiscal stimulus to keep the economy going. What that means is that even before China fell into balance sheet recession, Chinese companies are operating as though we were in balance sheet recession by not borrowing money. That forced the government to borrow money. And now, as this green line indicates, Chinese budget deficit is almost like 6% of 7 to 8% of GDP. And now that the bubble has burst, they will have to increase budget deficit from this point onward, and that's going to be very tough. And that's some of the challenges that China is facing right now. Thank you.
That's fantastic. Kai.
Thank you, Nicolas, and thank you, Richard, for your presentation. I just want to start by saying that we are really a great admirer of your work on balance sheet recession. As you said, your work is so well known in China. There needs no introduction of balance sheet recession in China. Actually, we at CF40 were among the very first during this period to introduce your concept, try to understand what's happening in China. I think we published a paper last June to think through of the implication of a balance sheet recession. What if it happens in China? How to respond to that? So just by way of introduction, Richard probably is the most popular economist in China right now. Everybody knows his name. That's a rare treatment of economist. I'll try to offer some somewhat different views on where China's economy is. We look at data more carefully over the past year. We just felt that it's very hard to fit China's data into the original framework of balance sheet recession. There are basically three reasons. One, there's no recession to start with. This year, according to IMF, China's GDP will grow 5.4%. 5.4 may be high, maybe low, depending on your expectation, but that's not recession. The economy is still growing. A second reason is that you don't really see a nationwide or economy-wide persistent deleveraging by corporates or households. If you look at Richard's last slides, I think if you look at the corporate borrowing, actually it started to grow towards the end of the cycle in 2022. And in 2023, corporate loans are still growing. If they are deleveraging, if they are paying back their debt, you should see that being positive, but that's not the case. And a third thing to look at is you really look at the balance sheet of corporates and households. Some of corporates' balance sheet are damaged, like the property sector, but at least many corporates and most households, their balance sheet are still above the water, not underwater. So if you look at it more carefully, it's really hard to fit the balance sheet recession concept into China's data. And we also have some different views on what the policy implication is. I think Richard made the case that monetary policy would be ineffective for China, so the only game in town would be fiscal policy. We believe that actually, yes, fiscal need to do more. That's in total agreement. But we also believe that monetary policy can help a lot. There are still room to cut rates, and there are still other ways of doing some balance sheet operation by the central bank to help the economy to grow faster. So we don't think the monetary policy is ineffective in China as of now.
Sorry to interrupt you. The sound quality has deteriorated from the beginning of your speaking to now. So I don't know if there is a way to fix that. But just if you know of a way, we can understand what you say, but it's not high quality.
Okay.
That's better.
Okay. So if China is not in balance sheet recession, what China is in now, in our view, it's really a quite standard macro recession, in the sense that China was in a state of insufficient demand before COVID, and then China was hit by a massive negative shock, mostly because of the real estate sector adjustments that put China into a big negative output gap scenario, and the response to that shock wasn't sufficient enough to offset the shock itself. So that's why the recovery was mediocre this year, depending on your view on where China should grow. So China is growing much below potential right now, but there are standard tools to address that shortfall by doing more fiscal and monetary. I'll stop here. Thank you.
Sorry, I was muted. I don't know, Richard, if you'd like to respond to Kai.
Okay. I fully agree with you that there are so many other issues involved, not just balance sheet recession, and those structural issues will have to be addressed. But let me just add that, balance sheet recession could start without asset prices even falling. So that's a variation of the theme. When people begin to feel that the house prices have already peaked, that it cannot go much higher than where it is, then people start borrowing money to buy houses, and that can start, in a sense, balance sheet recession. And I also hear, I was in China twice already, a lot of people saying, a lot of people now are paying down debt, not borrowing money, even though rates have been brought down to quite low levels already. So yes, central bank can bring rates even further, but I would doubt very much that borrowing will pick up substantially if people believe that house prices cannot go that much higher. And it could be actually coming down quite substantially, especially now that this whole talk of population declining is in the cards. In the Japanese case, population declined, but that's after 2009. So first 19 years, population was not an issue from 1990 to 2009. And one other point is that, of course, not everybody is affected by balance sheet recession. And one Japanese company that stayed away from this whole thing was, as you know, Toyota. Toyota was screwed by the bankers some 70 years ago, and the family said, never borrow money from the bankers, period. So Toyota never borrowed money. They never had balance sheet problems. So they continued to do very well and came up with this hybrid technology, which is actually far more involved than this electric car technology. But other companies, Nissan, Mazda, and all the others got stuck in this balance sheet mode, and that's basically pulled the Japanese economy down. But of course, some companies that were not affected by this balance sheet problem continue to do very well.
So I have a ton of questions, but I also encourage the audience to ask questions through the Q&A tool. We have many expert people in the audience, so it would be great indeed to have their questions rather than mine. But just to start, one thing that, because we're at financial statements here and because I'm obsessed with banking, one thing that is not very present in your narrative of the Japanese crisis, Richard, is the banking sector. Well, you work in the bank yourself, but it's an investment bank. And the banking sector was a big part of the evolution in Japan and indeed of the last decade in a standard narrative, right? And until Heizo Takenaka came up and, there was a cleanup of the banking sector in the early 2000s, that was a drag on the economy, or at least that's what the story of zombie banking asserts. So can you give us a sense of how the So balance sheet recession story connects with the zombie banking story, and also how that reads across to China.
Okay, I have a very strong objection to your standard narrative of what happened. Of course, with a massive balance sheet recession, tons of banks were in huge trouble. I mean, if commercial real estate prices fall 87% nationwide, a lot of banks will be in trouble. But the biggest problem in Japan was not the banks. Fixing the banks at that point would not have saved the Japanese economy. You have to fix the entire balance sheets of the private sector. And you can tell by the fact that even though there was some credit crunch, if there's a credit crunch is the one that's killing the Japanese economy, foreign banks who were not affected by Japanese bursting of the bubble should have come into the Japanese market. They did not. They actually stayed away and left to Japan. Corporate bond market should have done very well because that's not involving banks. Corporate bond market actually shrunk, and the spread between the lending rate and the funding rate of the banking system should have widened if banks could not lend the money. But there are a lot of people out there borrowing money. But the spread actually shrunk also. All of which indicates that borrowers disappeared faster than lenders. So lenders declined because of their banking problems, but the borrowers disappeared even faster. And so all these people who said, oh, until Takenaka came along, nothing could have moved forward. To me, that's complete nonsense. If we had a fiscal stimulus large enough to keep the borrowing going, the banks would have done much better, and the private sector could have done much better as well.
Kai, of course, in the Chinese case, the banks are a different proposition because they're the bulk of the banking sector, not all, but the bulk of it is state-owned. So there's a much greater consolidation with a fiscal perspective. But how do you see this issue of zombie lending and zombie companies in the context of China, reacting to what Richard just said?
There are a few things I want to mention. One is, China has spent enormous amount of resources to clean up the banking sector, especially those large banks in the past several years. So actually, if you look at the balance sheet of larger banks, their balance sheets are very clean. Some smaller banks have issues because of their link to local government debt and the local property market. But those big banks are okay right now. For now, I don't worry about zombie lending as yet. But as the economy slows and as the property market issues start gradually showing up on banks' balance sheet, I worry about the long-term health of their balance sheet. But for the short term, it's not a very urgent issue just yet. And lastly, I want to mention, because of what you mentioned, many of the banks are state-controlled. So we won't have that kind of very abrupt bank run or Lehman type of crisis in China. If anything happens, it will be very, very slow moving, and there will be time and the space to deal with it.
So there's a question from Nicolas Véron at the Peterson Institute. Richard, is deflation the result of a balance sheet recession or cause? And when did the price deflation emerge in Japan?
Well, one of my earlier chart indicated that both household sector and corporate sector were net savers, even at zero interest rates. And they were all repairing balance sheets as a result, in order to repair their balance sheets. And so that is the cost. The balance sheet is the cause of deflation, not the other way around. Definitely not the other way around. And that was also demonstrated this time around too. Governor Kuroda came on to become a governor of Bank of Japan. And he said, if we just pump the money into the system, get the inflation going, this whole problem will be resolved. And a lot of economists around the world also got onto the same kind of arguments, just pump the money into the system. Well, do you know how much money Kuroda pumped in? Almost the entire size of the Japanese GDP. The inflation got absolutely nowhere, still way below 2%. Because if no one's borrowing money, the money really cannot come out of the banking system to affect the real economy. It's the whole idea that if the central bank just pump money into the system, the money will be circulating in the economy is all wrong. We were not taught in our university days that you have to have borrowers out there for monetary policy to work. And if there are no borrowers, you can pump all the money into the system you want, and it will be still stuck in a banking system. And that's how we got zero inflation for so many years, in spite of this massive increase in monetary base.
Hi, there's a question from Rahim Ashkebusi about consumption. The question reads, can consumer spending exacerbate the balance sheet recession problem? Chinese consumer spending is below what advanced economies normally experience. I will add a twist to that question of my own, because several of my colleagues who have been in China recently, and myself included, when you're in China right now, you observe a lot of visible consumer spending. People are traveling, they're going into malls, etc. So what's your feeling about consumption? And it is true, as Rahim said, that it has been pretty low by comparative standards in recent years, but how also do you see the trends, and how does that play out in the macro stories that we're discussing?
That's for me or for Richard?
For you.
Okay. I think there are two broad macro trends on top of the structural issues happening right now in China. The baseline consumption in China is very low before COVID, so you have to keep that in mind. China's household save 30-40% of their income. That's the baseline. There are many structural issues behind that. I won't touch what's behind those. And most recently, I think there are two things happening. One is really people are coming out of COVID. There are still scarring effects that affecting people's behavior. So that recovery is somewhat slow, but natural recovery out of COVID. And you see a lot of consumption happening in terms of services. People are dining out. But on the other hand, because there are a lot of uncertainties about where the economy is going, and some general nervousness about income growth, so people definitely start to save more just for precautionary purposes. So that two broad trend actually is happening at the same time. That's why you are saying a lot of consumption if you go to those good restaurants or hotels, but you also see that at macro level, consumption is not as strong as in many other countries.
So do you want to comment on that?
Yes. No, during the COVID-19, developed world gave lots of money to households, even to companies, so that they can weather this shock, external shock called COVID-19. But the Chinese government did not give much money to households or companies. They did some help, but not as much as in the developed world. What that means is that Chinese households, Chinese companies had to weather that shock basically by themselves. And I heard that many indeed went bankrupt as a result. But during that period, I'm sure a lot of Chinese households and a lot of Chinese companies depleted their financial assets to make the ends meet. So when the economy begins to recover, they will naturally want to rebuild their savings to what they think is a safer level. But that can also cause balance sheet recession from the asset side. And that is that if everybody tried to increase savings to rebuild their savings, financial assets, that will reduce their demand, and that could cause kind of a balance sheet recession, with people feeling that their asset levels are just too low compared to the classic case where they think their liabilities are too large. And I think that's one of the key factors in China as well.
So we have several questions about fiscal space. There are questions from Helen Lai, from George Long about local government and local government debt, and that's a big issue these days in China. Mark Sobel is also asking about how much fiscal space exists if you take into account those contingent liabilities, which include, I would say, SOEs, banking sector. I mean, there's a kind of larger public consolidated balance sheet than just the general government accounts. So can you expand a little bit, maybe Kai first on this, on whether you see, also given the demographic problems, whether you see unlimited fiscal space as was kind of the received wisdom until recently in China, or whether at this point there begins to be an upper limit to what the Chinese government can expand?
A few points. One, if you really look at Chinese government's balance sheet, I mean there is a very nice recent IMF paper looking at both the asset side and liability side of Chinese government. In the conclusion, my takeaway is that Chinese government have not, the debt level is high, but not high compared to developed economies. And the Chinese government also have a lot of assets. So on net, they are still having a net asset. So, you know, from that perspective, I still think the Chinese government have sufficient policy room to address the current downturn. The fiscal room won't be unlimited, but what do you do? If you don't do fiscal, you're going to be in a scenario that you're going to have a deflationary pressure, you're going to have a slowdown of economy, you may eventually build up more debt over time. So I guess the best way to respond to the current condition is you do more fiscal, you lower interest rate, so the debt burden won't grow as fast as in a high interest scenario, and you bring the economy back to a more normal case. Then you think about how to address those underlying structural issues. I'll stop here.
Richard, do you think China has enough fiscal space to do as Japan did? In the case of Japan, the debt has gone to extraordinary levels without triggering its stability. Can China do the same?
Yes, I think so. And the reason is this. Balance sheet recession is caused by excess private sector savings. And so those savings are available in the financial market somewhere. So if the government just borrows and spends it, it's not going to put pressure on the financial market. And IMF and all these people were dead wrong for so many years on this point because they missed the perspective of investors or fund managers of institutional investors. When you're in balance sheet recession, all these savings comes into your financial institutions. Newly generated savings, debt repayment, more money pumped in by the central bank, they all come in, but there are no borrowers, right? They are all paying down debt at the same time. And if you are one of those financial institutions, like life insurance companies, where you are supposed to put lots of money in a safe, meaning high-grade fixed income assets, bonds, and when private sector is not issuing bonds, they're not borrowing money, the only borrower left is the government. And so you end up buying government bonds. And that's the reason why the bond yield has come down to such low levels, even though public debt has gone sky high. And this mechanism was never taught in our economics classes, but it happened in Japan, and then eventually happened in all the other countries after 2008, right? All the countries after 2008, the public debt level went up, deficit went up, but the bond yields came down to these very low levels because in the balance sheet recession, that's basically what happens. So it's the market's way of telling the government, please, this is the time to borrow money, not to consolidate your balance sheets. And if you heed this market's advice and borrow the money, then the economy will do well, tax receipts will be okay, and banking system can be, banking crisis could be avoided. But if you don't heed this message from the bond market, and continue to try to reduce your the deficit, which is what happened in Japan in 1997. In 1997, the IMF, OECD, thinking only those standard theories of the useless kind, told Japan to cut the deficit. And I was advising Prime Minister Hashimoto at the time. I said, don't listen to those guys. They don't know what they're talking about. If you cut the deficit, the whole thing will come crashing down. And it did come crashing down. We had 5 consecutive quarters of negative growth, complete breakdown in the banking system. And the budget deficit actually increased by 72% instead of decreasing by like 60%. That was the original ideas. And following year, the IMF team actually came to my office and apologized because I told them before they forced the Japanese government to cut the deficit that, you know, you should not tell the Japanese government to cut the deficit, because if you do, the whole thing will come crashing down. So what that means is that we have to think very, very differently when the private sector is minimizing debt instead of when the private sector is maximizing profits. And financing government is one of those issues that needs to be completely reviewed, because when the private sector is minimizing debt, the financial market dynamics are completely different.
So Olivier Jeanne is asking, if you spend so much, what kind of expenditure should that be? Is it social spending? China seems to have a lot of infrastructure, so maybe there's not that much space. Toshiyuki Miyoshi is asking whether it should be rural development. Can you give us a little bit of a sense of where the stimulus should go? Maybe Kai first on that.
I think if you look at what the government is doing right now, they're spending on a few things. One is on affordable housing. Another is shanty town renovation. The third is really those dual-use facilities that for both peacetime and emergency. They are also spending a lot of in the rural area. We also wrote a paper trying to argue that they probably should, through EITC type of program, to provide income support to low-income households.
EITC being earned income tax credit in the US,
yeah,
right?
Yeah, earned income tax credit, yes. So provide some support to low-income households. I think, I mean, there are a lot of places to spend. There's also argument to spend on social safety nets. So I mean, it's not really, I mean, you can find a place to spend money. It's really about how much you can spend on it.
Well,
Richard, yeah, in Japan, was there a big debate about where to spend, or how did that play out?
Well, let me first respond to your original question, where the money should be spent in China. I think money should be spent in China on all the unfinished residential projects and just finish them. Even if the developers are all bankrupt, government can take over those businesses and then finish them. I think that's the best way to get maximum fiscal stimulus for the same renminbi that you spend, because the buyers are already there, even though they might have regretted deciding to buy those apartments. But as long as they are completed and they buy those apartments, I think that's the best way to spend the money in China at the moment. And the second thing is that when private sector is minimizing debt and not borrowing money, interest rates come down to these ridiculously low levels. You know, a lot of people say, well, China borrows so much money and this and that, China has so much debt. Look at the interest rates. 10-year government bond in China is yielding 2.6%. It's half of the US level. That means the market is saying, we have too much savings. Government, please borrow. So all we have to do in China is to find the project with a social rate of return of higher than 2.6%. And there's so many bright people in China, if you put them in one room and ask them to come up with a social rate of a project with a social rate of return higher than 2.6, I'm sure there'll be a lot of projects. Maybe you teach the Chinese English. That might have a social rate of return higher than 2.6. And if it's higher than 2.6, that means it's not a burden on future taxpayers, because that's adding to future economic growth. Now, in Japan, your original question on the Japanese one, because we did not know that this is a balance sheet recession, we thought this is just a little business cycle kind of recession. which is what we were all taught in universities. And Kai actually mentioned that this may be one of those too. If this is just a short-term business cycle recession, you don't really think hard about what kind of project you put in. You just put in whatever that is shovel ready. And so Japanese government did that. And whenever they put in a fiscal stimulus, of course, the economy responded quite positively. But then when they removed it, thinking that Keynesian pump priming was working, then tanked again. And then they did it again, another shovel-ready projects. Then the economy responded. And then it was, economy is responding, public debt is too large, let's cut it. And then the economy went down again. Why? Because for pump priming to work, you need private sector with the clean balance sheets. Then they will be able to respond. But if private sector are all repairing balance sheets, then pump priming part of the Keynesian stimulus will never work. If we knew that in advance, we would have put in the 5-year projects or 10-year projects. But in those days, we had no idea that was what was happening. So we wasted a lot of money on some bridges to nowhere, roads to nowhere.
I think the idea of improving English language literacy is great. I don't know how the politics of that will play out, but I'm personally in favor. I'd like to come back to your point, the point you just made, Richard, about rates of return. And that connects with another part of Mark Sobel's question, which said, the PBOC in the past has emphasized maintaining the supply of credit and has a focus on less of a focus, on using interest rates as a policy tool. So monetary policy, first, what role does it play? And second, how vulnerable is the strategy you recommend against, unexpected inflation shocks? Because we've been reminded in Europe and the US that these things can happen.
Is that toward me? Well, when Bank of Japan was tightening monetary policy to basically kill the bubble back in 1991, 1992, they were so confident that if things crash, they can always bring rates down to zero. That was, in retrospect, false sense of security. Because then when they realized that something is going wrong and brought rates down to zero, still nothing happened. And that by then it was too late. So I would like to warn the Chinese people at the PBOC that don't feel so secure that you have additional room to lower interest rates and that should save the Chinese economy. That's the same mistake the Bank of Japan made back in 1990, 1991, that, hey, we still have room to lower rates and everything will be fine. Well, it didn't work because there were no more borrowers out there. So that's something that I hope China will not make the same mistake.
You want to comment on that? Including inflation risk, of course, not something for today.
I think China needs a little bit of inflation. If China has 2 or 3% inflation, the PBOC's job will be much easier than currently. Our GDP deflator actually is negative. Our nominal rate, 10-year rate, as Richard said, is only 2.6, but our real rate, if you look at GDP deflator, it's probably 3% or 4% real rate. So that is not low real rate globally. And that's why I also think that PBOC still have room to lower rates simply because the real rate is pretty high. If you lower nominal rate, that will help boost some of demand, and it's also lower the burden of debt to households, to corporates, and to government. So that's probably what they should do.
There's a question from an anonymous participant about so that really brings in the external dimension here. The point is that many Chinese, including business people, are taking their money out of the country, and that may be macroeconomically significant. Even so, it's not the same question. Jimmy Tsang is also asking about internationalization of the RMB and how that would help or hurt the economy given the current circumstances. So maybe Kai first on those two questions about the external account and how that intersects with the domestic dynamics that we've been talking about so far.
The way I look at this is really because of domestic demand is relatively weak and the savings rate are pretty high. So China is running a lot of current account surplus. That surplus translates into, in the past, PBOC went into the market to buy the surplus. That translates into reserves. Now PBOC is not doing that anymore. So all those current account surplus has to be corresponding to capital outflows. That is investment abroad. I think that's a natural process. There's also some of the diversification of supply chains given what is happening around the world. So I think that's a natural process of what's happening. In terms of renminbi internationalization, I don't see any direct link to the current economic issues. I mean, there may be long-term implications, but for the short term, I don't see a lot of direct implications.
Richard?
Well, I'm in the receiving side of that money, and the way it sounds is not very pretty at all. A lot of people are so scared of the situation in China. They just want to take the money out. And of course, that's very helpful for the Japanese economy, Japanese real estate market skyrocketing thanks to the Chinese money. And it's not just the money. A lot of Chinese actually coming to live in Japan because they're so scared over there. And so I don't think it's just the current account balance argument. It's quite a bit of capital flight in it. And the other part is that China is at the point where a lot of economists will call middle income trap. The wages, other prices are high enough. And there are other countries like Vietnam, Bangladesh, Indonesia that are offering just as good infrastructure and so forth, but at a much lower prices. And Chinese companies are moving out, foreign companies are moving out. And those, I think, are also adding to this problem. And if that's the case, I would like to see Chinese government make sure that domestic business environment is a lot more attractive than it has been through tax cuts, deregulation, and so forth. And since Mr. Xi's San Francisco visit, seems like Chinese government is beginning to move in that direction. And I hope this U-turn will continue. But until that time, a lot of foreign companies were not feeling very comfortable sitting in China, or some of them extremely uncomfortable sitting in China. And that was not just the Chinese companies also. Chinese entrepreneurs also moving money out like crazy. And so if you try to open up the capital market today, the monetary outflow could be far larger than inflow. And that could actually hurt the Chinese economy as well.
Well, I don't want to take you into political hot waters, but if you want to comment on that, what Richard said about a U-turn, the confidence in the private sector in China, there have been mixed signals of late.
Oh, I think if you look at the process of this year, I think it is improving. I mean, since September, I'm seeing more Americans in Beijing than the past several months or several years put together. So there are some positive signs that things are moving towards better direction. So I agree with Richard that there needs to be more clarity on the environment, and I think the government is aware of that, and they are trying to do things that is to be more conducive to foreign investment.
So questions is about those companies that expand overseas instead of keeping their business in China. Was there a similar phenomenon in Japan during the 90s, and was that positive or negative for the Japanese economy? How did that play out, Richard?
Japan, like China today, at that time was running a huge trade surplus. And that kind of prevented Japanese government from using the exchange rate to fight the balance sheet recession. if Japan at that time tried to bring the yen down, Americans would have complained bitterly. And if the Americans complain bitterly, the yen will go up in the opposite direction. And so if you're running a trade surplus, the option of using exchange rate to grow out of balance sheet recession is limited. Whereas South Korea, for example, during the Asian currency crisis, they basically fell into a massive balance sheet recession, but they were able to use the exchange rate to come out of it. You know, Korean won fell something like 70% from the peak, and that allowed Korea to come out of their balance sheet recession. But I don't think that option exists for China today, and it did not exist for Japan 30 years ago. And so that kind of forced the Japanese companies to invest abroad. And there are a lot of Japanese factories in the United States as a result to avoid this possibility of yen appreciation. It's not the most optimal in the sense of trade theories, but under the circumstances, when you have such a large trade surplus, there's not that much option. The option of using exchange rate, I'm afraid, did not exist. So companies had to adjust, basically.
Right. Ted Truman is asking whether it makes a difference that we're talking in the Chinese case, not really about a recession, but just a slowdown of economic activity. I mean, we're not talking about negative growth rates at any point. We're just talking at low rates compared to the potential and to the past. How much of a difference does that make? Maybe Kai first, and then Richard.
Yeah, I think thinking about China probably should always think in the context of a growth recession rather than a standard recession. But I guess the most important issue is really about the policy implications. I think Richard's assessment is that monetary policy would be ineffective under a balance sheet recession. I think my assessment is that monetary policy still have a lot of room and a lot of things to be done to support the economy. I guess that's the most important difference, I guess, between myself and Richard. I mean, I think we agree on fiscal needs to do more. I think that's the same.
Richard?
Sorry, what was the original question?
This question was, where in the case of China, we're not talking about a recession in the sense of GDP going down. We're just talking about lower growth rates.
Okay. Well, as you saw in the first graph, Japanese GDP never fell below the peak of the bubble. So Japan was already doing quite well, even with loss of wealth to that magnitude that I just described. The fact that in one of the last chart that I indicated, Chinese companies stopped borrowing money or start reducing their borrowings quite substantially from 2016 onwards. And the government had to do such a large fiscal stimulus to support them. Suggests to me that if the government did not take that action, if the regional governments didn't do all that fiscal stimulus, Chinese economy would have been much, much weaker starting around 2016, long before the bubble burst. And if I were a Chinese policymaker, I would try to find out why that happened. Because at that stage of economic development, where Chinese companies are so competitive, Chinese workers are so willing to work hard, study hard, they should be borrowing more and expanding, like Japan in early 80s or something, or late 70s. The fact that Chinese companies start reducing their borrowings and the government had to, or the particularly regional governments had to support the economy with their fiscal stimulus, suggests to me that there's something awfully wrong starting around that period. And that could be because of confrontation with the West or uncertainty over the various regulations, maybe population too. Well, those are the issues that I think Chinese government have to really address. But those are structural issues. And dealing with structural issues, of course, important. But when you have a balance sheet problem on top of it, after bursting of the bubble, that is, then you have two problems at the same time, structural problems and balance sheet problems. Balance sheet problems, in my view, is pneumonia. Structural problems, in my view, are diabetes. Both can kill you, but if you have both at the same time, you have to cure your pneumonia first, because this thing can kill you very quickly, whereas diabetes can wait. And so I really wish the Chinese government will stop this bleeding first and then go after the structural issues.
Indeed, we had a number of questions about structural issues from Pierre Raffi, Jipeng Tai, Lyric Hale, and Seth van de Voort in particular. Unfortunately, we're at the hour, so that's your medical metaphor, Richard, will be the concluding uplifting thought of the session. I am so grateful to the two of you, also because you stayed so late. It's very late in Beijing and even later in Tokyo right now. But first and foremost, for the extraordinary clarity and thought-provoking quality of what you gave us today. So thanks so much. We'll have the next session of this series on December 13. We'll talk about the Basel III banking capital reforms, specifically in the United States. And again, many, many thanks to Richard Koo and Guo Kai for illuminating comments today. Thanks so much.
Thank you.
Thank you. Thank you.
Thank you for having us.